My name is Michael Grandy. I'm a certified public accountant and I'm a professor at Providence College. This YouTube video is going to be on cost, volume, profit, and we're specifically teaching from the Kimmel book. This is chapter 19. It's actually cost, volume, profit analysis, additional issues. And I'd like to go through several exercises. The first one we're going to look at is from, again, chapter 19. This is going to be exercise 6. And let me read the problem, and then we'll go through the solution. Yard Tools manufactures lawnmowers, weed trimmers, and chainsaws. Its sales mix and unit contribution margin are as follows. So in the problem, they've given you the 3 products, and they're telling you what the sales mix is. 20% for lawnmowers, 50% for weed trimmers, and 30% for the chainsaws of their total sales. That's their mix. And they also go ahead and give you the contribution margin per unit. So they've given you a lot of information. Yard Tools has fixed costs of $4,200,000. That's for the entire company. So the very first question is, compute the number of units each product that Yard Tools must sell in order to break even under this product mix. So it's a fairly straightforward calculation. So we have our lawnmowers, which is at 20%. We have the weed trimmers, which is at 50%. And we have chainsaws at 30%. I mean, obviously the sales mix has to add up to 100%. Now the unit contribution margin, so this is the mix right here, and this is the CM per unit over here, and they give this to you as $30, $20, and $40. So what we want to do is come up with the weighted average contribution margin. So we're going to multiply for the lawnmowers. We're going to take the 20% times $30. The weighted average contribution margin is going to be $6. And again, 50% times $20, that's going to be $10. And then the 30%, that's going to be $12. So the weighted average contribution margin per unit is $28. And we want to calculate break-even point in units. And we remember that formula. Break-even point in units equals a fixed cost divided by the contribution margin in per unit, right? Per unit. And that's on the weighted average basis, of course. So this is going to be $4,200,000 divided by $28 per unit. So this is 150,000 units. So that's number of units. Dollars divided by contribution margin per unit is going to give you 150,000 units. So they, in order to break even, have to sell 150,000 units. Now the question is, what is that mix? Well, again, the lawnmowers, the weed trimmers, and the chainsaws, they have their sales mix at 20%, 50%, and 30%. And we need to multiply that times the number of units, right, to break even, 150,000. So 20% of 150,000 is 30,000 units. 50% of 150,000 is 75,000 units. And 30% is 45,000 units. And this should equal the total of 150,000 units. So that's how many units of each product they have to sell under that scenario. So let's look at another problem. I don't know how this is going to erase. This has not been erasing well. See if we can clean it up a little bit with this stuff here. So let's take a look at the next exercise. This would be exercise 10. And let's read it. It says personal electronics sells computer tablets and MP3 players. The business is divided into two divisions along product lines. CVP income statements for recent quarter's activity are as follows. So we're given, and you can see this is exercise 10 from chapter 19. They give you a contribution format income statement for the tablet division and the MP3 player, and they give it in total, asking for us to do four things. Then we'll determine the sales mix based on sales revenue and contribution margin ratio for each division. B, compute the company's weighted average contribution margin ratio. C, calculate the break-even point in sales dollars. And then determine the sales level in dollars for each division at the break-even point. So the first thing they're asking you for is what is the sales mix in dollars? And that's pretty easy, because when you look right at it, a sales mix for the tablet division is $600,000 on total sales of $1 million. So that's obviously 60%. And then the MP3 player has $400,000 of the $1 million. So that's 40%. Very straightforward. Item number, so it says determine the sales mix percentage on the sales revenue and contribution margin for each division. So that one's just a smidge more difficult. But again, so what we're looking at there is what is the contribution margin for each product. And you can see that the tablet division has a contribution margin of $180,000 divided by total sales of $600,000. The contribution margin percentage there is 30%. And the tablet division has a contribution margin in total dollars of $140,000 and sales of $400,000. The contribution margin percentage is 35%. Again, very straightforward. Now, item B is asking you for the weighted average contribution margin. So weighted average contribution margin, that's where you take the total contribution margin, the combined contribution margin of $320,000, and divide it by the total sales of $1 million. So they have a weighted average contribution margin of 32%. Item C says calculate the break-even point in dollars. Now again, that's a relatively easy calculation. That's going to be a break-even point in sales dollars. That's going to be your fixed cost divided by the weighted average contribution margin of 32% divided by 0.32. So we have total fixed cost of $120,000 divided by 0.32. The break-even point in sales dollars is $375,000. So combined sales of $375,000. And then lastly, item D is asking determine the sales mix in dollars for each division at the break-even point. Well, what's important to remember here is the original sales mix. So for the tablets, they had 60% of sales, and the MP3 player had 40% of sales. Again, that's from the original data. We need to keep the sales mix constant. And again, it was a 60-40 split from the original data out of the $1 million. And then all we're going to do here is multiply this times 375 and multiply this times $375,000. And it's going to tell us what we need to have. So we got $225,000 here, and we have $150,000 here. This is what the sales mix has got to be, and this must equal $375,000. So that is exercise number 10. Again, a pretty straightforward problem. Let's take a look at exercise. This is going to be a problem now. So this is going to be problem 1A, problem 1. And let's read the problem. There's a little bit more going on in this one. Midlands Inc. had a bad year in 2021. For the first time in its history, it operated at a loss. The company's income statement showed the following results from selling 80,000 units of its product. Net sales, $2 million. Total costs and expenses, $2,235,000. Net loss of $235,000. Cost and expenses consisted of the following. So what you see here is you see the total expenses. In the first column, they got cost of goods sold, selling expenses, administrative expenses. And then they break it down between variable and fixed between the two of them. Remember, total revenue was $2 million, and total expenses, both variable and fixed, $2,235,000. They obviously have a loss of $235,000. It goes on to say management is considering the following independent alternatives for 2022. So option A is to increase unit selling price by 25% with no change in costs and expenses. So they give us 3 independent options here for improving profitability. Let's read the instructions first. It says item A, compute the break-even point in dollars for 2021. And then B, it says compute the break-even point in dollars under each of the alternative courses of action for 2022. And then it says which course of action do you recommend? So let's take a look at the first item here. It says compute the break-even point in dollars. So A is a break-even point in sales dollars. And you remember that formula, fixed cost divided by contribution margin per unit. Contribution margin percentage, right? And we say, well, what are our fixed costs? Again, they have a column, total expenses, variable expenses, and fixed expenses. The fixed expenses are $1,035,000. And the contribution margin percentage, which you have to calculate, right? The contribution margin percentage would be the total contribution margin. And this gets a little complicated. So remember, it's going to be sales. And they said sales were $2 million. And then what are the variable costs? Well, the variable costs, they said, are $1,200,000. So the contribution margin in total dollars is $800,000. And we remember how to calculate the contribution margin percentage, right? It's going to be contribution margin divided by sales. So you've got $800,000 divided by $2 million. And that's going to be what? 40%. Right? The contribution margin divided by the sales number is 40%. So the CM percentage is 40%. Fixed cost divided by the CM percentage of 40%. You have a break-even point in sales dollars of $2,587,500. In case you can't quite see that, it says $2,587,500. That's the break-even point in sales dollars. So you can clearly see when they only have $2 million in sales, they're losing money. And that's why, because they're well below break even. So that's item A. So now let's get on to item B. So remember the current, let's just put this up here, the current break-even point in dollars is $2,587,500. That's where they are right now. That's the current break-even point in sales dollars. Let's take a look at the alternatives, right? So item 1 says increase unit selling price by 25% with no change in costs and expenses. So you need to essentially recalculate sales price and variable cost. So they're saying the sales price, well, what was the sales price? The original sales price was $2 million divided by, so that's going to be sales, right? The original sales number were $2 million. The number of units that they sold was 80,000 units. So the sales price was originally $25. And what are they saying here? They're saying they want to increase the unit selling price by 25%. So say times 1.25, right? So the new selling price is going to be $31.25. This is sales price. The contribution margin, what was the contribution margin? Well, the original contribution, what was the original variable cost? The original variable cost, take their variable costs of $1,200,000 divided by the number of units of $80,000. So their variable cost per unit is $15. There's no change there. Variable cost. So the contribution margin, the new contribution margin is $16.25. We're interested in the contribution margin percentage. Contribution margin of $16.25 divided by the sales price of $31.25. The new contribution margin 52%. So under scenario B, the contribution margin percentage is 52%. So what's the break-even point in dollars? Well, remember the break-even point in sales dollars equals the fixed cost, which we said was $1,035,000, divided by the contribution margin percentage of 0.52. The break-even point in dollars is $1,990,385. Under that scenario, right? Break-even point in sales dollars, $1,990,385. That's alternative one. Let's look at another alternative. Alternative 2 says, change the compensation of salespersons from fixed annual salaries totaling $200,000 to salaries of $40,000 plus a 5% commission. So what's happening here? Again, it takes a little bit of work to figure these things out. So where were they? Where is previous? Here's our change. And here's our new number. We're going to look at this. We're going to look at sales. Previous sales were $2 million. There's no change here, so the sales are $2 million. And remember, from a percentage basis, the sales number is always 100%. What about variable costs? Variable costs were $1,200,000. And what are they saying? Change the compensation of salespersons from a fixed annual salary totaling $200,000 to salaries of $40,000 plus a 5% commission on sales. So if sales are $2 million, sales are $2 million, sales commission is going to be 5% of that number. So times 5%, that's going to equal what? $100,000. So we're going to add $100,000 here to our variable cost. So our new variable cost is $1,300,000. Contribution margin, right? Sales minus contribution margin was $800,000. We're going to add $100,000. It's going to subtract it, right? Because it's an expense. It's going to be $700,000. My new contribution margin, total sales $2 million minus variable cost of $1,300,000. My new contribution margin in dollars is $700,000. This percentage is now 35%, right? $700,000 divided by $2 million. Contribution margin percentage now is 35%. So we need to calculate break-even point in dollars. It's the fixed cost divided by the contribution margin percentage. So we know the contribution margin percentage is 35%, it's 0.35. But doesn't the fixed costs change? So they were $1,035,000. Fixed costs were $1,035,000, but there was a change. It says, again, read it. It says, change the compensation of salespersons from a fixed annual salary totaling $200,000, so it was $200,000, to total salaries of $40,000. So instead of paying them $200,000, they're only going to pay them $40,000. So there's a drop of $160,000, right? They were paying them $200,000. Now they're only going to pay them $40,000. So there's a savings in salaries of $160,000. So fixed costs drop to $875,000. The new fixed cost of $875 divided by 0.35, break-even point in sales dollars is now $2,500,000. Let's look at another scenario. Let me see if I can clean that up a little bit better, guys. So item C, it says they would purchase a new high-tech factory machinery that will change the proportion between variable and fixed costs sold to 50-50. The cost of goods sold, right? Let's read it again. Purchase new high-tech factory machinery that will change the proportion between variable and fixed cost of goods sold to 50-50. So it'll be exactly equal. So we're going to take the total, we're going to calculate the total cost of goods sold, variable plus fixed, and then now it's going to be 50% of that number will be variable and 50% will be fixed. So let's take a look at that one. Item 3. So let's take a look at where fixed costs are, our cost of goods sold is now. So we have cost of goods sold. You've got variable at $1,050,000. You've got fixed at $518,000 for a total of $1,568,000. So it's going to be 50-50. So 50% is going to be $784,000. The fixed cost right now is $518,000. So there's going to be a shift of $266,000. Well, what does that mean? That means that we're going to add $266,000 to the fixed cost and subtract it from variable. So we're going to subtract 266 over here and we're going to add 266 there. So the new costs are going to be 784 and 784, right? To be equal. So let's take a look. So there's a shift. There's a shift here. And this is cost of goods sold, right? So let's see what that means. Let's take a look at the new contribution format income statement, right? We've got sales, variable cost, contribution margin, fixed cost, net income, right? That's how that works. So we have the change over here, and we got new. It was $2 million. There's no change. The stay the same. And again, this is always my 100% number. The variable cost, the total variable cost was $1,002,000. But there's a shift in the cost of goods sold, so we're going to subtract 266. My new variable cost is $934,000. Remember, that's the shift. We're dropping the variable portion from the cost of goods sold, and we're adding it to fixed costs. So we had $800,000 in contribution margin. 2 million minus 934. Contribution margin is now $1,066,000. And we can look at our percentages, right? This is going to be 53.3%. My new contribution margin is 53.3%. What happens to fixed costs? Well, fixed costs were $1,035,000. And we did what? We added $266,000, right? There was a shift from variable to fixed. So the new fixed costs are $1,301. still have that same loss, $235,000. There's just what? A shift in from variable to fixed. So these are the numbers that are important for us right here, right? The new fixed cost is 1,301,000. The new contribution margin ratio is 53.3%. So let's take a look. Let's do that calculation. So this is our third scenario, right? It's going to be BEP dollars, fixed cost divided by the contribution margin, 1,301 divided by 0.533 equals 2,440,901. That's new break-even point in sales dollars. Let's go back. Let's look at 1. And we had these, we previously calculated them, but just let's reiterate them very quickly. Number 1 was BEP in sales dollars equals that 1,035 fixed cost divided by 0.52. That number was 1,990,385. In our second scenario, we had break-even point in dollars. It was 875 divided by 0.35 was exactly 2,000,000. $500,000. So without any changes, the break-even point was 25875. Scenario 1, Scenario 2, Scenario 3. So they ask an interesting question here. It says, which course of action do you recommend? Well, my thinking was, it's not easy choice, but I said, raising the sales price is always difficult. So that was scenario 1, right? Scenario 1, they raised its selling price by 25%. They can't just do that. What if they have competition? So raising the sales price can be difficult. Number 2, what are they doing? They're changing salary. They're changing the salary structure to move to sales commissions. So they're going to, rather than give people a fixed salary, they're going to give them a commission. Now, the nice thing about that, when you put somebody on commission, it tends to motivate them and they'll work harder. So you don't have to change your sales price to make this thing work. You just put your salary, put your employees on sales commission. Number 3, that's essentially automation, but you're dramatically increasing your fixed cost. Look how much fixed costs go up. From our original scenario, it goes up by, $265,000. That's a lot of money. Increases fixed costs, which puts more pressure on sales revenue and may lead to layoffs. Going to lead to layoffs because if you automate your business, you're going to have to get rid of some employees. So I guess what I'm liking scenario number 2, because you don't have to increase the sales price. Fixed costs drop dramatically down to $875,000, so that your employees are motivated because they're on commission. So I would go with number 2. So that's not an easy problem, but it really does encourage you to learn the cost, volume, profit, income statement and its structure and related relationships within it, and really drills home the ability to calculate break-even point. So thank you very much.